Hello and welcome to an FXTimes daily market recap. I'm your Forex market analyst, Nick Nassad. Today is Thursday, March 4th, 2010. We'll start today's broadcast with a look at our two central bank decisions. The first, when the European Central Bank kept rates at 1% and at the same time tried to maintain a balancing act between laying the groundwork for mopping up extra liquidity in the banking system, while at the same time maintaining favorable lending conditions so that the Eurozone recovery is supported. At the same time, it has to deal with the fallout from the Greek debt situation. ECB President Trichet said that the euro system continues to provide liquidity to the banking system of the euro area at very favorable conditions. He said that the ECB will continue to lend as much money as needed through its 7-day operations as well as its 1-month operations, and extending that pledge till at least October. So that's an extension of stimulus measures meant to cement the recovery. However, the ECB did take some steps to tighten monetary policy, as the 3-month market operations will be returning to its pre-crisis practice of offering those funds at a variable rate. Also, the 6-month tenders will be paid by an index to the average of the ECB's main rate over the maturity of the operation, which means the banks will pay more than the current 1% if the ECB raises its benchmark rate. So the overall implication is that despite the problems in Greece, the ECB is determined to move to tighten monetary policy, albeit at a somewhat slower pace than before. On the topic of Greece, the ECB would like to convince markets that it can force Greece to put its fiscal house in order itself through spending cuts and increases in taxes without the need for the ECB to give the country financial assistance. Moving on, we had the Bank of England interest rate decision where they kept rates at 0.5% as expected. There was no expansion of the £200 billion quantitative easing plan, which was paused in last month's interest rate meeting. The Bank of England believes that the full impact of the bond purchase plan has yet to come through, and it will be looking at the outlook for inflation in order to decide whether to expand purchases or whether to begin withdrawing stimulus in the coming months. The meeting may have been overshadowed by the upcoming elections in the UK and how the country's politicians will deal with lowering the current budget deficit, which is running at very high levels and is pressuring the pound in currency markets. Overall, this meeting seemed to meet traders' expectations, and there was no major surprises. In the US, we saw jobless claims for the week ending February 27th drop by 29,000 to 469,000, which was a better than expected result. Also, continuing claims dropped by 134,000 to 4.5 million. That was the fewest continuing claims since January 2009, though that figure does not include the number of Americans receiving extended benefits under federal programs. Still, the data was a better than expected report, and it helped to show that the U.S. labor market is improving, though quite gradually. It helped Greenback to strengthen in today's trading, and it comes prior to tomorrow's non-farm payroll report. The euro-dollar pair moved in favor of the dollar as better than expected U.S. jobs contrasted with the fiscal struggles of the eurozone. ECB President Trichet offered relatively little to investors, which wanted assurances on Greek debt, and with the Friday non-farm payroll data approaching, it seems that traders want to square their positions, and we've fallen back into this consolidation zone we've seen the past 2 weeks. In New York trading, the euro slid even further as we had Moody's Investor Services downgrade Deutsche Bank, which highlighted continuing fiscal concerns in the eurozone, as well as putting a spotlight on the European banking sector. Deutsche Bank has been considered to be one of the stronger banks in the European system, so this was definitely a negative development and pressured the euro. If we take a look at the euro-pound pair, we see that the euro dipped here as well, as we have seen a bit of a rounded top around the 91 area in this pair. That follows very strong gains by the euro in last week's trading and in Monday's session. We now test this support level around 0.9030 to see if we have a further slide in the pair and a further correction to this rally. There wasn't a very strong reaction to the Bank of England decision, which came out around here, with the pound testing its resistance from yesterday around 1.5130, But as we had the greenback strengthen in New York trading, the pound gave up those earlier gains, and we were testing support around 1.5020. Now let's turn away from the pound and the euro and the central banks and take a look at the dollar-yen pair, which saw a rather strong rise in favor of the greenback as we moved above our short-term level of resistance around the 88.60 area. That occurred in the New York morning trading, and that helped us to retrace some of the losses the dollar had seen in yesterday's session. We now approach resistance for the pair. Short-term resistance as well around the 89.50 region. So while we had some general greenback strength, what we're seeing here also is that the cost of borrowing in yen for 3 months between banks, or the LIBOR rate, that cost to borrow yen fell below that of the dollar for the first time since August, which reduces the appeal of the greenback as a funding currency in carry trade. The dollar had moved below the yen last year for the first time after the Federal Reserve held interest rates at a record low. That has fueled a lot of greenback weakness whenever there was a risk appetite, as traders took advantage of the very low rates to borrow in dollars and then to park those assets in higher yielding currencies. It seems now that the yen will be again reclaiming the mantle, however, of the main funding currency in currency markets. One important reason here is that the U.S. economy is showing signs of strengthening faster than Europe and in Japan, and it seems that the Fed will be able to move quicker to wind down some of its emergency lending programs and to eventually begin to raise interest rates. Japan, meanwhile, with its fear of deflation, will continue to have a zero interest rate policy. If we zoom this pair out a bit more, we see that the dollar had slid against the yen rather sharply in the past 2 weeks after we reached the 92 level. So we'll see if perhaps we're seeing a bit of a bottom in the pair, and if we see a move back in favor of the dollar in Friday's session and in next week. In a final market highlight, we're going to take a look at the Australian dollar-US dollar pair, and we had seen the Aussie rallying throughout the week and just at the end of last week, and following hitting our high around 0.9080. Today's session we saw the Aussie give back some of its gains, testing the area below 0.90. Gold prices were down, and overnight we saw the Australian dollar weaken against both the greenback and the yen, as Japanese companies are bringing home overseas earnings before the fiscal year ends this month, so that increases demand for the yen. Also, with slowing growth in Europe, it dampened demand for higher yielding currencies. The fundamental docket is rather light for tonight and overnight, as we have a measure of construction activity from Australia, and then producer prices from the UK and factory orders from Germany. But the real main risk event will be the US non-farm employment change and the unemployment rate, which will come out tomorrow at 8:30 a.m. The figures for February are expected to show a rather steep drop in jobs, though it seems that the very harsh weather seen in the US in February could account for an increase in job losses. We'll also get data on earnings as well as consumer credit in tomorrow's session. So that will wrap up today's broadcast. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.